Hello there, everybody. This video is going to cover the first tax return we did in the course, the one on the corporate income tax. And this was a pretty challenging return to work through, so I wanted to go through this pretty much line by line, talk about some of the differences that we see between book income that we see for financial statement reporting versus what we're actually going to report as our income for income tax purposes for a corporation. So we're going to look at the differences between book income and tax income and talk about how some of these different rules we've looked at throughout the course actually get applied to specific situations. So we have here a bunch of information about XYZ Corporation. Notice this is kind of preliminary information. So this is what we would see if we're looking at the company's financial statements. So if we're looking at the income statement that's published for the purposes of SEC publication issues and whatnot, this is the numbers we would see. Now, this is going to be different from what we file on our tax returns. So we're showing that we have about 1.259 million income after taxes for book purposes, but we're going to see there's going to be some adjustments between these numbers that we see here on our income statement and what we're actually going to report on our tax forms. And we're given a bunch of information here about the different operations of the company. I'm not going to go through each particular point here. If you haven't reviewed this tax return in a while, I'd suggest just going back and looking at what you did really quickly, and this might help compare against any issues you might have had as you prepared it, and kind of reread, just review the facts of the case here. I am going to come back to this as I work through the problems, but I won't read through all these different scenarios right now. But just notice all this information given here is going to be the basis for making those adjustments from book income to taxable income. So that's what we're trying to do here in this spreadsheet. We're trying to go from the book income amounts to taxable income. I'm going to discuss every time there's some discrepancy between what's reported for book and taxable. We're going to talk about why these numbers might be different. Notice we have this little column here for credits and debits, kind of making adjustments, going from book income to what we're actually going to report on our tax return. If a little T's next to it, that means it's just a temporary adjustment. So it's going to affect taxable income. There's going to be a change between taxable income and book income this year, but that's going to reverse itself at some point. The P means it's a permanent difference, that it won't reverse itself. So as we go through some examples, maybe that'll make some sense. And so each time we have a little difference, I'm going to talk about that here. So notice our total revenue we had from sales of $40 million. That just gets kind of transcribed down here from, I'm taking all this information from over here. So we have 40 million in sales. Our cost of goods sold was 27 million. So of course we deduct that. And we have a gross profit of 13 million. Notice that's the same both for book and taxable income. Now we start to see some differences here when we get into this category of other income. So notice we have $300,000 that we made from income from investment in corporate stock. So we owned another corporation. So if we go up here, it talks about the facts of the case. We own 30% of Hobble Corporation here. So Hobble made $1 million actually in income for the year. So we have to report our share of that. All right. So basically, being that we own between 20 to 80%, all right, we own 30%. We use the equity rule of calculating this. There's different rules you'd use to calculate taxable income that you received from investments in another company based on how much you owned of that company. So we're kind of like in the middle tier. So basically, if you own between 20 to 80% of a company and we're at 30, so we're in that tier, you're just going to multiply, all right, the amount of income that company made times your ownership stake. So we own 30% of the company. We multiply that times $1 million. That comes to $300,000 in income that we recognize on our books for our financial statements. All right, so notice that's what we have down here, that $300,000 recognized as income from corporate stock, we're only going to calculate 200,000 of that includable as taxable income, because out of that 300,000, 200,000 came in dividends to us. The other 100,000 was just capital appreciation for that company that we owned. All right, so they earned an extra $1 million in profit. We're entitled to 30% of that. Well, we got paid 200,000 in dividends. The other 100,000 never got paid to us. That other company is still retaining that money. We have a right to it. We have a claim to it. That's why we're including that 100,000 in book income, but we don't have to pay taxes on that 100,000 that was not distributed to us. So the 200,000 in dividends we're going to include here in taxable income. And notice later we're actually going to have a dividends received deduction. All right, so you have 130,000 right there, and we're eligible to deduct up to 65% of the dividend income we received from that other corporation. All right, so that's kind of preventing triple taxation, where we're a corporation, we're paying taxes on dividends earned by another company, and they've already paid taxes, and then eventually we're going to send dividends to our shareholders. They're going to pay taxes again. So this discount here, notice that's reducing how much we pay in taxes. All right, that's a reduction of 65% of this number up here. So we include the 200 up here, all right, for all the reasons we talked about before, that we get rid of that 100 off the 3. And then out of that 200,000, 65%, this 130, and it's a negative 130 here, all right, that's going to be taken away. So really, out of this 200,000, all right, we're only paying taxes on 70,000 of it. So that's kind of the point of all those different rules there. So that gets kind of complicated when we have investments coming from other companies. As a corporation, you need to take into account what is our investment stake in that other company. So what percentage of that company do we own? And then we want to look at if we're receiving actual dividends or if we're just kind of passively receiving capital gains as that other company makes money. All right, so kind of moving on to the next category, interest income here of $20,000. So notice that's all the interest we got from bonds. We know from our individual taxation class that local bonds are tax-free, so that applies to corporations that own these bonds as well and receive interest from these bonds. So notice we have a $12,000 adjustment. That's just the total amount of tax-free interest we received. So notice up here we had a $5,000 City of Seattle bond, so it's a municipal bond that's tax-free. $7,000 from Tacoma City. All right, so that's 7 plus 5, those city bonds. That's $12,000 total. Our company doesn't have to pay taxes on that. So even though we're reporting $20,000 in income on our financial statements, well, we're going to preclude $12,000 of that because it's municipal bond interest, and we're only paying $8,000 there. Notice this capital gains and losses, the $4,000. That capital loss can't be netted against ordinary income, so that's going to go away. Notice it's temporary, though. Eventually we will be able to get credit for that capital loss, but as of right now we're bringing 0 over here. Kind of opposite case here with this gain on fixed asset disposition. These were assets used in the ordinary course of business. I think it gives us a little detail on that down here, and it was used for less than a year. So we don't net out the capital loss. We can just kind of bring that over here in this column. The 3,000 transfers over, so no real adjustment there. Miscellaneous income, same idea. The 50,000 that we reported on the book income is the same for taxable, and we're going to see that once we get to expenses. Some of these expenses are reported in the same way for book and taxable purposes. I won't spend a lot of time going through those. Our compensation, that's one of those. That's our total compensation. So, that's an expense to our company. That's a write-off for both tax and book purposes. Notice stock option compensation, not the same thing, though. We do write that off for an expense for book purposes for our financial statements, but that's not an excludable expense. We can't take that as an expense for tax purposes. So notice that doesn't come over. We don't get that deduction per the IRS rules. So repairs and maintenance, that just comes over. Same idea, rent, bad debt expense, those just both kind of come over from the columns, whatever we show for book income. Same idea for taxable income, no adjustments for those. Notice depreciation. that we had $41,000 that we were gonna, oh, actually that's the bad debt expense. So we had bad debt expense of $41,000. We're only recognizing 27 of it though, and that's the actual bad debt expense that was written off. So accounts that were written off this year. If you go into the detail of the problem, it talks about the idea that, yeah, we wrote off $41,000 as an expense, but we only really took 27,000 actual losses. The rest of this was kind of an estimate of how much of our sales we're going to lose going forward. So for tax purposes, we can't take that. That's going to be a temporary difference. Once those estimated accounts are actually written off in practice, then next year we'll be able to take that 14,000 loss. But as we can see, it's less of a deduction, so less of an expense that we're realizing. Depreciation, it just tells us, and this is a challenging problem overall, that they could have made it a little worse by actually having you calculate depreciation, but basically they told you in the problem that depreciation was $1.9 million for tax purposes, so they didn't even tell you how that was calculated. That would be a whole kind of issue to have numbers and work through that. And corporations have, in some cases, entire departments that track fixed assets and calculate depreciation and look at salvage values and things like that. But so we're not going to get into that for the purposes of this tax return. It's just told us that 1.9 million was the taxable depreciation amount, so that's what we're going to use, and note that there's a difference between what we actually reported on the book and what we're told were being used for tax purposes. The warranty expense, it's not going to come over for tax purposes because no warranties were actually utilized this year, so no actual expense. That's an estimate, so that's why we have the zero there. Notice mills. One of the rules we looked at in prior chapters was you could only deduct half that expense. All right, so there's the $18,000. That's how much we actually spent as a company for mills, and we reflect that in the income showing up on our income statement. But when we do taxes, you can only take half of that. So 18,000 divided by 2, all right, the 9,000 gets taken right there. So that accounts for that adjustment. Organizational expenditures. Before we get there, goodwill impairment. And I'll try to get really quick through these last few. This is kind of running a bit long, but goodwill impairment, basically, this is how much we were taking for our book purposes. It looks like a straight line deduction was made. If you go back to the numbers, I think it's $300,000 taken over 10 years. For tax purposes, though, you're not allowed to calculate it that way. All right, it has to be over 180 months. That has to be 300,000 divided by 180. All right, times 6 months, and that comes to 10,000. All right, so that's where that $10,000 comes from. Let's see if we have. I think I have that calculation here in Excel. All right, so notice here that I have 300,000 divided by 180. 300,000 was the total amount of goodwill. And just remember, goodwill is if we buy a company and we pay more for it than what its total assets are worth on its books, that difference is goodwill. So we call it amortization. Basically, it's like depreciation for goodwill over time. We take a little bit of an expense for that each period. So the question is, how much can we take for tax purposes versus book purposes? So for the book purposes, like we were saying, all right, we just used straight line. We took the 300,000. And that must be what we paid over and above what the assets of the company was worth. So we bought a company, maybe it had assets worth $3 million, and we paid $3,300,000. All right, so that extra $300,000 we paid over and above the value of everything the company owned. That's what's called goodwill. All right, so if we divide by 10, which is straight line over 10 years, that gives us $30,000, which is what we used for the purposes of book value. All right, but if we do this calculation here, which is what you're supposed to do for tax purposes, all right, take the amount of goodwill divided by 180. All right, do that, you get, this is a monthly figure, 1,666. Well, we bought this company 6 months ago. They state that in the problem. If you take this times 6, notice that's what I did in that formula, you get 10,000. All right, so I think that maybe was a source of a lot of confusion for folks on this problem, so I wanted to spend a little time in detail on that. Just keep in mind that's why we only have 10,000 here. That's the official way to deduct that goodwill amortization for tax purposes. All right, so I'm just going to kind of scroll down through the rest of this stuff really quickly. Notice we had a couple adjustments for organizational expenditures, and basically you're allowed to take $5,000 if you have less than 50 grand in organizational startup expenditures. You could take $5,000 as a straight up write-off, and then you kind of prorate the rest of it. So that's what we did here to get this figure of 7,600. And notice we have it kind of in the footnotes here. If you want to kind of press pause, I'll let you read through that. But I'm going to continue on here. And notice, I mean, at the end of the day, this is our amount of taxable income. So we've went through almost every category, every calculation here. There's a couple I didn't quite go through in detail at the end, but I kind of want to get to the tax return and just show how this all kind of comes into play. So this is what we're reporting for our financial statement purposes. This is how much income we're actually paying taxes on. So notice it's kind of a bit more, right? So we're paying more on paying on a bigger amount here for taxes than what we report for financial statement purposes. And notice if we scroll down to the tax return, we see that's the amount we actually pay taxes on. The total tax is just that amount times 21%. So if you would take, all right, the total amount times 21, and you get 392,355. All right, which is what you have right there. So that 21% rate is the average tax rate you'd have for a company of this size. And notice we paid $480,000 in taxes throughout the year. All right, so way up here when we talk about the company's history, notice they made 4 equal estimated tax payments totaling $480,000. So the government got $480,000 from this company throughout the year. They only owe $392,000. All right, so the difference is how much they overpaid. So this is their tax return, the $87,644. All right, so all these numbers that go into the return here, those just flow from the calculations we talked about in that spreadsheet. You know, the kind of difference between the book and taxable income. And notice you can see the initial numbers are the same. Notice that $13 million in gross profit. Remember the dividends, the $200,000 we include there. But then later on, we talk about our dividend deduction here. All right, notice the $130,000 that we talked about earlier. So out of that $200,000, $130,000 gets taken away. So we're only going to really claim $70,000 overall. We talked about the idea again with the interest. We're only including the taxable interest. So we had those 2 city bonds; those aren't included. And you know, these numbers are just coming from, all right, this little spreadsheet we did here. All right, so notice $8,000, that's what we're keeping out of the interest income. All right, so you can pull down all those numbers basically from that chart to kind of populate the different columns here. So if you go through that, you know, that's the basic gist of doing one of these corporate returns. There's a lot that goes into it. All right, and I'm going to just finish this up while I have a little bit of battery. So, you know, if you have any questions, please let me know. I'd be happy to go through this in more detail. You know, studying for the exam, going through this and understanding the rules underlying each one of these calculations and, you know, these categories that you're going to look at for different inputs for your tax return. That's really helpful going through the examples that the book gives. So as you're working through studying for your test, please let me know if you have any problems, and best of luck to you.